I am Greg Hunter. Welcome to USAWatchdog.com. With us once again, a top investment guy, Axel Merk of Merk Investments. Axel Merk, thank you for joining us today on USA Watchdog.
Great to be with you.
I know you are the president and the chief investment officer. You have almost $500 million under management. You're the big picture guy, but let's start with this little smaller picture, the unemployment report in the United States last week. How is it looking for you in your investment theme?
I think the framework you're putting on this, big picture, small numbers, I think people are losing the big picture here. People think that, the reasonably good number means we're going to be tapering, it's going to mean this and that. I think we'll get a great number of economic data that economists will predict to the second decimal, but they will be completely wrong as to the market reaction. That unemployment report, for example, gold initially sold off, and then it came back. People think that tapering means that somehow the dollar is going to go through the roof and gold is going to be shattered. Well, look at the 1970s. The Fed was behind the curve. The S&P tumbled, gold soared. The Fed has almost promised they'll be behind the curve. And so the biggest threat we are facing right now is that these numbers actually stick, that we have good economic data, because guess what? The bond market is going to tumble and the Fed is going to be late in reacting to it. We've had the glass half empty for so many months. S&P has gone to the stratosphere. I think no matter what type of data we're going to have going forward, brace yourself for volatility, and you may want to look for some protection somewhere.
Well, it's been reported that you keep 50% of your net worth in physical gold. So you think that's a good play?
My non-real estate net worth, to just clarify that, and I don't count that every day. It was a little earlier this year. Gold has come down since. But yes, I do hold a substantial part of my net worth in gold. And that's mostly because I don't like anything else out there. That drifted us into the currency space 10 years ago or so. And we obviously, I hold a substantial part of the rest of my liquid net worth in active currency management. And the reason really is that prices don't reflect fundamentals in the stock market. There's a huge amount of complacency. To us, and in my investment career, complacency is the best bubble indicator. Complacency when tech stocks always go up in the 90s, housing goes up, the bond market is the only place to invest in. And look at the VIX index in the stock market in combination with rising stock prices. It is terrifying to be in stocks, in my view anyway. So I sleep much better at night with my gold holdings than with my equity exposure.
It's had a tough couple of years, gold, for our gold investors, which is why one of the reasons why I wanted to have you on. You're a guy that believes in it. I mean, you have a lot of your net worth, personal net worth in it. And why don't you like anything else? I mean, is it because of the massive amount of debt, the massive amount of bond buying, the phony accounting, the fraud and criminal activity? I mean, what?
No, it's not. Those obviously, they all obviously factor in. What I don't like is that prices don't reflect fundamentals. You cannot price an asset if you don't allow the market to work. And when you flood the market with liquidity, you cannot price it. We have, in the short term, we have a Fed where we don't have leadership. That makes it difficult. The euro, by the way, until the summer of 2012, people were running around like headless chicken. You cannot price an asset in that sort of environment. You need to be able to price an asset to agree or disagree. What prices reflect is the next perceived intervention of policymakers, the next big move, the next major regulatory change. And you have capital misallocation in that. And in that sort of environment, I don't like to chase prices. Think about Warren Buffett. He didn't invest in tech stocks in the 90s. He did quite okay. I don't need to follow that craze. I might be missing out on an upturn in the market. And by the way, we do have one fund that's participated in the S&P and beat the S&P. So it's not like we're completely out of that. But overall, I don't like that game to just chase somebody else chasing prices higher. I like to look for value. And when there's no value in the market, I'd rather stay out of it.
Well, when Warren Buffett was not investing, he avoided a big bubble and a big crash in tech.
Exactly.
Are you saying that there's a big crash coming in the stock market? I mean, the minute that the 10-year goes up.
I definitely think about what happened in gold in April. Gold plunged on almost no liquidity. Well, who says that cannot happen in the S&P? At some point, people think that there is infinite liquidity these days. Who thinks somebody is going to provide liquidity when somebody decides to take a profit? The sort of price corrections we've had in gold. People, you talk about manipulation. Well, clearly hedge funds like to move the markets around, and then the momentum players come in, exacerbate the trend. As long as that's good for stocks and negative for gold, regulators don't care. But the same thing can happen in reverse. And so who says that somebody's going to provide liquidity when somebody decides to take a profit in the S&P? And by the way, the gold is an excellent diversifier in times of when the S&P does go down. It doesn't always go up when the S&P goes down, but historically it's happened many times. That's why compared to the 1970s, where the Fed was behind the curve, we had a rising environment, a rising interest rate environment, and gold did very, very well. The short of it is, I think we have too much debt in the world. Many countries, including the U.S., will prefer to use a printing press to push the can down the road. And so gold is just the simplest of investments. But clearly, when everybody piles in on gold and gold goes up for 12 years in a row, yes, there will be a correction. There can be a severe correction. But on a risk-adjusted basis, gold has done just fine. And by the way, the volatility in gold in the long run is only a tad higher than that of the S&P. And that's just one asset here compared to a diversified portfolio. And so clearly, you've got to be able to stomach the volatility. But I'm quite comfortable with gold.
Do you think that we're reaching some sort of an inflection point? I mean, people like Jim Rogers says, well, gold's going to go down. He's not selling his gold, incidentally, which tells me that he may be a little worried that when it gets down to the price that he'd like to buy it at, there may not be any there because people are buying into the fall. But he says it's going to go down a little more, but it's going to go way up. What do you say?
Well, the challenge with timing is always that people always want to buy at the bottom, sell at the top. It never works that way, and didn't work in tech stocks, didn't work with the housing bubble. So I have people tell me, oh, I'm going to sell the dollar when it comes down. I'm going to buy the gold when there's an opportunity. Well, the opportunity was 10 years ago to buy it. And so similarly, there will be opportunities, but the question is more, what risk do you see out there, and how do you take those into account in your portfolio allocation? So if you think there's a risk that the Fed will be behind the curve, how do you take into account? Of course, you can buy equities and saying, hey, inflation is going to push up stock prices. But if you don't think they're cheap, what are you going to do? You're going to go to bonds? Well, most people don't think bonds are a good buy. So then you're going to go to cash. Well, what about the purchasing power of cash? And that's why in our shop we focus on actively managing currency risk and diversify to currencies and kind of assuming there are going to be currency wars. But talking about gold plays into that very well. Gold is more volatile than currencies are. But in my view, over the next 10 years, I'd much rather own gold than, for example, stocks or bonds.
Well, then you have to add in to your gold equation things going on in the Middle East and things going on in Japan and China with the Senkaku Islands and this 600-mile long, air defense, the edict that China has come out with. They're fighting over these islands. Reportedly, there's natural gas and oil in and around the waters there. What is going on with Japan and China and the U.S. in the middle? I mean, our number one creditor and our number two creditor. And boy, that sounds like a lose-lose. I said that last week on my weekly news wrap-up. What do you think about this situation?
Well, there are two topics here. One is gold as a fear play, and that's one of the reasons why gold has come down a bit, because the fear of a Eurozone collapse and the like have come down. And Janet Yellen even gets that in her testimony for her confirmation hearings that was mentioned. But the bigger play you're pointing out here to Japan, I see it mostly as an expense issue. Japan wants to get inflation, wants to boost the economy, so they'll do anything, including rebuilding Tokyo for the Olympics, or specifically here, potentially ramp up military spending. And again, the biggest threat that we are facing for the Japanese, but also the U.S. is that they'll actually succeed with economic growth. What do you think is going to happen to the bond market then? How do you think governments can finance themselves if we get economic growth and these bonds are plunging? The Bank of Japan is expected to jump in to put a lid on the yields. And of course, what's going to give is the currency. Now, clearly, as these policies are pursued, I think, shorting the yen is one way of playing it, but owning some gold is probably a good insurance against this inflationary mania that may come down the pipeline.
So you think that they're just saying this to ramp up their military spending? There's even talk of them amending their constitution to allow them to declare war. After World War II, the U.S. took away the power that they
Well,
that they could declare war.
I'm not even suggesting they kind of have certain intentions, just how I see the dynamics play out. I think globally, the one thing that I see is populism is on the rise. And in Japan, we have a populist leader, Abe, who wants to spend and print money. The reason populism is on the rise is because real wages aren't going anywhere. When you have real wages be stagnant for a decade, but the cost of living goes up, you have revolutions in the Middle East, you have Abe in Japan, we have the Tea Party and Occupy Wall Street in the U.S. It's only the Germans that love austerity, and with the new government out there, they'll probably throw that out of the window as well. But that means less political stability. It also means more government intervention. And when you ask me about what I'm going to do over the next couple of years, the reason why I don't like stocks is because I think the heavy hand of policymakers is going to stay there. We're not going to go back to a normal environment. On that note, Janet Yellen said she's going to go back to a more normal monetary policy when the economy is back to normal. Well, that's impossible as long as the Fed is doing what it's doing, because you cannot price assets when the Fed is flooding the market with liquidity. And so we have this oxymoron. We're not going to get out of this. We're going to have more aggressive intervention by policymakers. The good news in all of this is only that our policymakers are predictable. And so that provides opportunities such as shorting the yen or possibly buying some gold.
And that's why you think that the overall macro policy globally, it's not just the U.S., it's just about everybody in the world, everybody's going to keep their foot on the gas. They're going to keep printing money until, well, it blows up. Is that your assessment? Well,
it's not quite as simple as that. I think one has to be differentiating. In New Zealand, for example, there's some good economic numbers. So the dynamics will be complex. But the thing is that if you want to be tactical, you can be a step ahead of the policymakers, anticipate the next turn. The Brits, for example, everybody thought Mark Carney is just going to step on the accelerator. Well, there are a bunch of tailwinds in the British economy, and actually for the first time we turned positive on the sterling, at least in the short term. In the European Central Bank, they're just structurally not capable of printing as much money. And so that gives opportunities. But the point here is that we're not going back to historic norms. We're going to have very active policy engagement. The debt is not going away. We have more flexibility in the U.S. than others to kick the can down the road, but we're not going to solve our problems. So we'll be here discussing this probably for a while. The risk is that something is going to blow up, but the more likely scenario is that we'll just keep our heads spinning. Everybody's going to wonder, and everybody's going to say, I'll buy gold if and when it's necessary, and we'll talk again at gold 3,000, and everybody's going to still say gold is worthless.
That's a good point. Final question in the Middle East, because I'm asking these big global pictures. A lot of people are just being lackadaisical about it. They don't think, you don't see a lot of reporting here in the U.S. about the Middle East, but there's, assassinations taking place in Lebanon. There's still a high alert in Jordan. Syria, the civil war is not going up. There's new charges that came out last week from the UN about the Assad regime committing atrocities, and they're, on their way to Geneva to, have a peace conference in Switzerland. And boy, that just seems like a big bucket of rusty bolts.
Well, the sad thing is that the markets react more to when the Draghi, the head of the European Central Bank, is sneezing than any of those horrible things you're mentioning. But again, I think it is a symptom that we have less stability in the world, and it's not just in the Middle East. It is a global phenomenon. The political cost of the policies that have been pursued is rather dramatic, and we'll see that with more tension throughout the world, less stability, and ultimately an erosion of purchasing power around the world, and that makes for very difficult politics, and ultimately it means inflation is going to be the path of least resistance in many places around the world.
And you're saying right now gold is you would be buying into gold even if it went down another couple $100. Your thesis would be hold gold, buy more as it goes down if you really want to protect yourself from.
Well, I'm comfortable with it. I mean, everybody, you mentioned I hold a great deal of gold. I'm not suggesting everybody should do that, because ultimately you need to be able to sleep with the risk that you have in your portfolio. And if you can't sleep at night because you're nervous, then do something about it. Now, I happen to be more nervous about my equity exposure. For the first time ever, I bought for my personal portfolio put options on my equity portfolio. I've been doing that every quarter because I want to sleep at night. But similarly, of course, if you have a lot of gold and can't sleep with it, then you have too much of it. I am very comfortable. I'd rather hold gold over the next 10 years. I happen to think bonds are going to be one of the worst investments over the next 10 to 20 years. And sure, others are more interested in what's going to happen the next 2 or 3 days. And if you think you can trade on that short basis, well, go for it. So everybody has to realize that what they do is risky. And gold is risky too when your daily expenses are in dollars. So there is no safe haven in the world. There is no place to hide. And that's really the challenge. And the folks who try to do the right thing, such as put everything into a savings account, obviously are losing out as well.
Axel Merk, thank you for your big picture views on the world and investing. And hard to argue with that thesis that governments are going to continue to. There is no normal market coming. It's just going to be more or worse of what they've been doing.
And the good news of that is that you can devise investment strategy where you project your views that what policymakers may be up to onto investment, rather than analyzing the earnings of your high-tech company. Analyze what central bankers are doing. Put yourselves into the shoes of them and what they might be up to. That's what we do in our shop. It's very painful to do that sometimes, but we think that's the way that you can make money in the years to come. And if anything, it presents for very, very interesting discussions and insights.
Axel Merk, you are of the Merk Investments. You are the president and chief investment officer. Thank you for joining us today for a very enlightening conversation on USA Watchdog. I love this. Thank you.
My pleasure.